Good day, everyone. I am Jenna O. Santoya from the Group 3, and I am the fourth reporter to discuss the theory of substantive tests of liabilities. Audit of long-term liabilities. The following assertions, audit objectives, and audit procedures apply to long-term debts. As you can see in the table, we have assertions, objectives, and audit procedures. We have five assertions. First, existence of occurrence. To determine that the long-term debts exist at year-end. 1. Obtain an analysis of long-term debts and accounts and related interest, premium, and discount accounts. Number 2, review debt agreements and confirm with payees the principal amount, maturity date, interest rate. Number 3, inspect bonds redeemed, retired, or surrendered during the period. Second assertions is completeness. To determine that all transactions relating to long-term debts are properly recorded. 4. Trace authorization for issuance of debt to credits to the long-term debt accounts. Vouch borrowing and repayment transactions and review transactions to supporting documents occurring near year-end. 3. Rights and obligations. To determine that the long-term debts represent valid obligation of the entity. Review minutes of Board of Directors meeting. Review payments and renewals after the statement in financial position date. 4. Assertion, valuation or allocation. To determine that the long-term debts are recorded at the proper amount. Recalculate interest expense and amortization of premium or discount if any. Ascertain the amount of long-term debt maturing within 1 year. Last assertion is presentation and disclosure. To determine that the long-term debts are presented and disclosed in accordance with PAS or PFRS. Evaluate presentation in the financial statement of the long-term debt. Examine classification of obligation as either secured or unsecured. Discussion of audit procedures. First, obtain analysis of long-term debts, accounts, and related interest, premium, and discount accounts. The long-term debt accounts may include bonds payable, mortgage payable, and long-term notes payable. The analysis of these accounts will show the following: beginning balance, additional notes or bonds issued, and payments during the year. The schedule will also present the beginning balance of interest payable or prepaid interest, interest expense, interest paid, and ending balance of interest payable or prepaid interest. Number 2, review debt agreements and confirm with payees or appropriate third party the principal, interest rates, maturity date. The auditor should examine the client's copies of notes payable, bond indenture instruments, and supporting documents such as mortgages and trust deeds. He should also send confirmation requests to payees or auditors to validate information about date of origin, due dates, unpaid balance, interest payments, and collaterals for the debt. Number 3, inspect bonds redeemed, retired, or surrendered during the period. Physical inspection of these bonds may be conducted if they are in the custody of company officials. If, however, the bonds are handled by a trustee, the trustee's reply to the confirmation should include information about bonds redeemed, retired, or purchased for the Treasury. 4 and 6. Trace authorization for issuance of debt to credits to the long-term debt account. Review minutes of Board of Directors meeting. The auditor should read the minutes of the Board of Directors and shareholders meetings concerning the issuance of debt. Number 5. Vouch borrowing and repayment transactions to supporting documents and review transactions occurring near year-end. Proceeds for borrowing should be traced to remittance advices, bank deposit slip, and to the bank statement by the auditor to obtain evidence to the validity of the transactions. Likewise, checks used to pay the principal and interest should be examined. Number 7. Review payments or principals and renewals after the statement of financial position. This procedure is performed by the auditors so that they may be aware of any unusual transactions with company officers, directors, and affiliates. It would also afford them additional evidence on the proper classification of their liabilities. 8. Recalculate interest expense and amortization of premium or discount. Recalculation of interest payments is a means of bringing to light any unrecorded interest-bearing liabilities. Checks drawn in payment of interest should be traced of cash records. The auditor should independently complete the amortization of premium or discount on debt as part of the total interest expense verification process. 9. Ascertain the amount of long-term debt maturing within 1 year requiring current assets. Long-term liabilities which will not mature within the operating cycle and any debt that will mature but will not be liquidated from current assets will be classified as long-term debt obligations. Any debt maturing currently and payable from current assets will be a current liability. Maturity date of the debt is traceable to the debt instrument itself. Verify the source of repayment. Last, evaluate financial statement presentation and adequacy of disclosure of long-term debts. Classification of debts by types of pays as to secured or unsecured, currently maturing or long-term should be followed in the presentation of liabilities. Secured liabilities and pledged assets should be cross-referenced to one another with an explanation in the notes of financial statement. And that would the last part of my report. Thank you for watching.